In this video, we are going to talk about cost curves of miners and commodities. And we're going to see that the price of a commodity typically follows the cost curve. It's about 50%, 100% higher than the cost curve. So how does a cost curve look like? This is a cost curve. So on the x-axis, you can see the cumulative production. And on the y-axis, you see the cost. There are low-cost mines like Glencore, and they typically have a very low-cost production. Now, as the price increases of the commodity, in this case copper, then another miner will come into production. For example, Southern Copper. And as the price rises more and more, then more miners will be able to go into production. And at some point, we get to an exponential phase because there are not enough miners to produce copper at a certain price. So here we will see the price of copper go exponentially higher to $5, $6, $7 because nobody can produce any copper anymore. All the low-cost mines are here, and we need more higher-cost mines at a higher copper price to produce more copper. So this is what a cost curve actually looks like. It goes up to the right. Okay. Now there is also a demand curve, and the demand curve looks like this. It goes down when you go to the right. Why is this? Because if the price goes up of copper, then I don't want to buy that much because the price is so high. Here the price is high, so I buy less quantity of it. As you lower the price, you go to the right, and you will be able to buy more of it. So that's a demand curve. This is our supply curve that we saw here. Okay. And this point of intersection is the equilibrium price. So at this point, these miners will be able to produce at a profit. They will be very happy. But these miners to the right will not produce anymore, because at this price, this guy here will not produce. And they will close their mines, and this will be the equilibrium amount of production. Right? That's easy to understand, right? Now, I think copper demand will go up, right? Because we are going into an EV revolution, we need copper to build all these EVs and infrastructure. So the demand needs to go up. So that means this curve will shift to the right, right? Because we need higher demand for copper, and this price then will need to rise. Okay, so we were here, and if you want more copper, then the price needs to go up to incentivize more production from these mines. For lithium, for example, we are doing like this, and that's why the price has gone up so much with lithium. To incentivize more production, but we don't have that production yet. Okay. Now, why do I think that the lithium price will go down? Because lithium is so easy to produce. A lot of these mines here can just double their production, quadruple their production. So what happens is that this curve will shift to the right like this. So more of this low cost production is coming online, and that will decrease the price from here back to here. Okay, so quantity rises, more lithium mines and more lithium demand is coming online, but the price is coming down because it is very easy to produce lithium at a very low cost. This thing will go to the right and the price will go down. Okay, now for copper, that's another story. You cannot bring copper online anymore at a low cost. So this curve cannot shift to the right anymore for copper because there are no high-grade copper mines anymore in this world. So you are not going to see a lot of these low-cost mines come online. We will need to bring new mines online, of course, but they will come from the higher cost mines. So this section will need to go up. So what happens is that this curve will probably shift more like this instead of like this. It will be more coming from these high cost mines. So on one hand, the demand goes up, and on the other hand, this curve will shift to the right, but at a higher price. Okay, so that's important to understand. That's the difference between copper and lithium. So how do we estimate this? We just look at examples. So let's take a look at some examples of commodities. We have silver. Silver is currently at $23. So at the 80-90%, 90 percentile of production. So that's already pretty high. So typically the intersection is around 75%, right? If you go to here, then it will probably go back down because a lot of mines will come online. So I would look for the 75 percentile for the intersection. So if silver goes, for example, to 15, then you would see that a lot of mines will be shut down, and then supply will go down, and then the price will need to go back up to reopen those mines. Okay, so around 75%, keep that in mind. Here you can see the silver price compared to the costs, and you can see that the price is typically around 50% higher, 50% higher here, 50% higher here. Yeah, it's around 50% higher typically. Sometimes it goes up double the cost, but then it comes back down. So typically 50%. Zinc production is around 1.2 per pound, and we're currently at 1.1 per pound. So yeah, think it's around the 75 percentile as well here. Here is copper again. Copper price compared to the cost, and typically it's around 50% higher, right? Here it's double higher. Here it's 50% higher. So I would just estimate that the commodity price will always be around 50% higher than the cost curves. Currently, copper is at almost $3 in production cost, and if you add in the all-in sustaining cost, then it will be around 3. Here again, it's around $3. If you count in inflation, because this is probably an old chart. Then uranium. Uranium, this was from 2021, so probably a bit higher now. If we take the 75 percentile, then we are at $40, $50 cost. Add 50% to that, then we get to $70, $80. So I think the long-term price of uranium should be around $80. So there's still some upside. But if it stays at $80, then Kazatomprom and Cameco are going to increase production. And they do have low-cost production, as you can see here. So as you know, this curve will shift to the right like this. And that will mean that the price will come back down to the cost of production, which is around 50, 60. So take that into account when you buy uranium. Could go to 100, 120, but it will come back down to the cost curve. Uranium cost curve, yeah, around 2030, 2030. Maybe it's now 40 due to inflation. Tin is at 27,000, also at the 80 percentile. So typically the price of the commodity is at the 70, 80% of the cost curve. Okay, that's a good way to measure it, estimate it. Okay, it can go up a tiny bit more, like 30, 50%, but it's mostly settles around the 80% level. Oil, yeah, oil is around 40, 50, 60. Currently we are at 86. So yeah, again, 70 percentile. It could go to 100, 120, but I think it's going to be around 80, 90 eventually. Around 50% above the cost curve. This is the break evens of oil for the shale oil, and it's around $50, $60. Add 50% to that, and we're at 100 to 90. So that should be our long-term price of oil. Same with gold. Well, gold is an exception because gold doesn't follow the cost curve. Gold is priced in interest rates, in exchange rates, in par value, in inflation of goods. So this is actually an exception. So don't look at gold, don't look at the production cost for gold. For what's this? This is iron ore. Same, the iron ore should be around $60, $70 cost, third quartile, and iron ore price is now at 110. So yeah, again, 50% higher than the cost curve. Platinum group metals. So the cost curve is around 700 all-in sustaining, and currently PGMs are at, I think, 1000. Yeah, 1000. So again, 50% higher than this cost curve. Potash is at 300 per ton, and the price of potash currently is 400 per ton. So again, 30%, 50% higher than the cost curve. Lithium, yeah, this is the LCE carbonate price. I would say it's around 20,000. And now we are 40,000. So yeah, I think it can go down to about 30,000. Yeah, around 30 to 20,000, because these are very easy to bring online, very low cost. Spodumene, very low cost, around 500 to 600. Currently the price is at 3,000, so the price is going to come down to this cost curve, probably around 1,000, 1,500, not 3,000. So expect spodumene to come down in price. This is coal. Coal is around $80 per ton cost curve, and the coal price is at 160, so double the amount. Okay, that's a normal price. China is buying more coal, so it could stay around this level for coal. Gas break-evens around 4 to 5. Okay, it's under the break-even, but don't forget, natural gas is a byproduct of oil. So production will keep on rising if oil production goes up. But anyway, these cost curves are very important. You need to know how the cost curves are today. For example, I made a lot of mistakes when natural gas was at 8. I didn't look at the cost curves. I should have looked at them. So it was at $4 cost curve. I should have known that the natural gas price would go back to 4 to 5 and would not stay at 8. Okay. Same for potash. Also made the mistake on potash. Potash, let's take the potash price. Do I even, yeah. So this was the potash cost curve, around 300. Potash went to 1,500. Okay, 5 times the cost curve. I should have known that potash cannot stay at 1,500. I should have known that it would come back to 400 to 350, which is 50% higher than the cost curve. And I will not make this mistake again. Okay, so this is a warning. Spodumene is currently at 3,000 per ton, and the cost is only 500 to 600 to produce it. So You already know it. Spodumene is going to drop in price. I have made this mistake twice with natural gas, with potash, and I'm not going to make this mistake again with spodumene. So prices will probably come down to around 1,000, 1,500, and that will be it. So cost curves, be aware of them. The price will probably go back to the 50% higher than the cost curve, following the 70 percentile of the cost curve, and you need to be aware of them, or you will be making the mistakes by thinking that commodity price will stay high forever, but that's not the case. And I'll see you in the next video. Bye.